September 3rd, 1982 marks the start of a financial revolution for all retirees, all things financial planning, for US banks, some would say, trying to stay afloat. Here's why. So we have to start a few years back. We go back to 1979. This is when universal life insurance was created. Now, essentially what happens is E.F. Hutton, who's often the pioneer or one of them of universal life, basically looks at the tax codes for insurance. He sees, okay, money grows tax-free inside of an insurance policy. You can access it tax-free, and when you die, it transfers tax-free. He says, hold on, we might have an opportunity here. So what he does is he looks at universal life and he says, every form of insurance, basically what we're doing is we're saying, how can we get the most amount of life insurance possible for the least amount of premium? Of course, if you're buying insurance, wouldn't you want it cheaper? That's not what he thought. He looked at it the other way. He said, well, wait a minute, if this is tax-free growth, what if we got the least amount of insurance possible for the most amount of premium and let that grow tax-free, still considered an insurance policy? Well, wouldn't we blow all these other vehicles out of the water? And that's what he did. Now, as Doug Andrew would put it, for example, what happens is the IRS comes around and says, hey, what are you doing? You're moving all this money into these insurance policies. We don't like it. He says, I'm just following the tax codes. Let's go to court. They go to court. He wins. The IRS still doesn't like this. They go to Congress. They basically say, hey, something needs to change here. Then comes in the topic of this video, TEFRA of 1982. That's the Tax Equity and Fiscal Responsibility Act. 2 years later came DEFRA, otherwise known as the Deficit Reduction Act. We'll get into that in the next video. But TEFRA was kind of designed to say, hold on, let's redefine what a life insurance contract is and what is the minimum amount of insurance you can have for the most premium. Basically, let's make sure that someone's not putting in $10 million for $10,001 of insurance. Otherwise, the banks, the credit unions, our financial institutions might be in trouble. What I want to look at is section 266, titled Flexible Premium Contracts. Now, there's three main things I want to go over. The first one, and this relates to section 101A of the Internal Revenue Code, telling us money inside an insurance contract can transfer tax-free. There's another video on that if you want to get more details. However, what it says is, when is this not subject or considered gross income? When is insurance passed on or loaned or taken from a policy and not taxed at all? That's the first thing that 266 goes over and redefines. Now, next is the introduction of the guideline single premium and the guideline level premium. We still use these today. In short, and not always, but generally, the guideline single premium, that's how much total premium we're going to put into the policy. The guideline level premium, that'll be used more in just monthly funding scenarios, and that's how much you can put in a year. Guideline level, guideline annual, those are names you'll both hear for those. So let's say you want to move over 500 grand into a policy, and that is going to be your guideline single premium, essentially saying, this is how much money I'm going to put in, not a dime more, not a dime less. 500 grand is what I want to move in. Hey agent, when you structure my policy, make sure the guideline single premium is that 500,000. So that's the second thing. The third thing here, and I'll pop this up on the screen, but what it's going to go over is defining the corridors and the different ones for how much insurance you'll actually need based on your age, gender, and health. So for example, an 18-year-old healthy female is going to need much more insurance when she puts in $1 million as opposed to a 60-year-old male in a wheelchair. It's just how it is. Now, one thing you'll notice here on the screen is you see in parentheses, but not below 105%. This has actually changed once you get to, it's generally age 95, it'll depend on the carrier where you need no insurance. But if you have $1 million in there, at a minimum, in general, you are going to need 5% more than that in total of insurance. So $1,050,000 in this case. So you'd only be paying for $50,000 in insurance because $1 million counts as the death benefit. So you're only paying for that small 5% more, in that case, $50,000 more. Now that's TEFRA of 1982. What started happening was people are moving money quickly out of banks into these policies in one swoop. They're getting their tax-free benefits, they're getting their tax-free access, they're getting their tax-free wealth transfer. The banks, surprise, were putting their tier 1 assets here as well. Basically the money that you put in the banks, they're loaning out, putting in there, getting their tax-free growth, and earning an arbitrage. In short, TEFRA didn't actually stop anyone from doing anything, they continued doing it. They realized this really quickly. Less than 2 years later, TEFRA came about, Deficit Reduction Act. Next video, we'll go over its adjustments and how it then and still today continues to serve as a revolution. We'll see you there.